Hello everyone, today is August 26th and this is Wyckoff Student Forum 2022. This is a very unique event. This event was done for students, by students. All of the presenters are our current Wyckoff Analytics students. Today we're going to have two presentations. Well, one for sure, we're still waiting for Arif to join us. So let's just hope that he's going to join us once Joe is done. I'm your host for today, Roman Bogomazov. I'm the founder of Wyckoff Analytics, for those of you who don't know, and also I teach WTC and WMD classes. Important disclaimer, everything that we talk about in this presentation is for educational purposes. And I hope that you will appreciate that these are your peers that are going to be presenting. These are the ideas that they come up with, or they take an idea and they extend it, expand it. And that's what's of interest to us. And, this is the second event. The first event that we had, Wyckoff Student Forum, was in 2019. We are coming back to this format. A lot of the students that presented at that 2019 event actually became our content contributors. This is the way for you to kind of like get into the company, teaching, presenting, content creation rotation. So for those of you who are interested in pursuing, well, I will not be that far off to say pursue some kind of even career in this field. This is obviously a way to go about this. Become our student, become very active, start producing some kind of content, start presenting, and then we'll present you with some opportunities, to expose yourself. Okay, let's go through some of the upcoming events. So on Monday, we are launching the new fall semester of 2022 for Wyckoff Trading Course series. Specifically on Monday, part 1 will be taught. This is all about analysis. It's a complimentary open door session at 3 p.m. Pacific, so please go to our website, sign up. If you can't attend, sign up anyway, because we're going to send you an email with the link of the video, and you could just watch it at your convenience. The fall semester is 15 sessions, and we study several topics. The main two main topics is the market structural analysis and supply and demand, or price and volume analysis. Those are kind of like the key foundational modules for us in terms of the acquisition of the knowledge of Wyckoff methodology. So under the Wyckoff structural analysis, I'll be talking about how do we actually define different market environments. How do we see that switch from one environment, so let's say from trending environment to a non-trending environment. As we go into the non-trending environment, how do we actually go through the phase analysis, where we are identifying Wyckoff events, identifying certain phases for the timing of it, and then after that we go to the price and volume analysis, where we are defining the bias and where we're defining potential character of the price coming out of the trading range. Then we quickly visit the theme of the relative and comparative analysis. A lot of you kind of like familiar with this knowledge, but we definitely put our own twist on it. And we go into the basics, into the creation of relative and comparative analysis. And then I'm going to show you some of the interesting small techniques, for your selection algorithm. Trade management. This is kind of an introduction, which is going to be more important even going forward in WTC2 Part 2. Under the trade management, we'll talk about the Wyckoff trading plan. We'll talk about the points of entry, stop losses, targets, exits, and so on and so forth. And then the last session, as always, is devoted to the to your questions. So kind of like a fun session to end the whole semester. I mentioned WTC2. This is a continuation of the Wyckoff Trading Course series. Now part 2 is all about execution. I always tell students and kind of coined this phrase, knowledge is not the skill. If you are aggressively pursuing the knowledge and you're the beginner, I think this is totally fine. But once you go to more intermediate advanced level, all of the knowledge should come from the chart. That's just kind of like my very strong opinion. I've seen this from all of the students in the last 10 years. It's a big mistake to hoard the knowledge and not to actually trade and practice the skill of trading. So the part 2 of the WTC series is addressing this issue. So we call this class the practicum. This is where we practice, where we deliberately practice. So we definitely apply the knowledge that we took from WTC1 and go into the drills and exercises. Each class, you're going to have the homework, a bias homework, a bias game homework. We will review this in each class. You will also have the homework, which we call anatomy of the trade. This is the post-trade analysis of your past trades. There will be a presentation by students, on that at the end of the semester. And we're going to dig much deeper into the knowledge. I'm going to give you a lot of proprietary, not necessarily Wyckoff material, but Wyckoff related material. So for instance, we're going to discuss significant bars. So a bar by bar analysis, we're going to discuss the swing analysis. Those are the two primary tools for us in terms of how we read the chart. So we're going to be reading the chart a lot during those sessions. And then another big educational block in the WTC2 part two is the types of analysis. We have developed at Wyckoff Analytics 3 types of analysis, which are bias analysis. So this means that in 3 different ways, you could go about analyzing a trading range and defining whether it's an accumulation or a distribution. Those are sequential analysis, flashcard analysis, and also a quantifiable analysis. All of that we study and we apply it right away in the classroom environment and for your homeworks with the bias game and other exercises. So check it out, complimentary session actually on Tuesday. Let me correct this. Tuesday, 8:30 at 3 p.m. Pacific. Again, sign up on wyckoffanalytics.com. Okay, our first presenter is Joe, and Joe has been a student of ours for quite some time, as he says here in his biography, Wyckoff biography. He stumbled across Bruce Fraser's Power Charting series, and please check it out. Bruce has written so many blogs in the last, I think, 5+ years. So it's kind of like I always tell students, it's kind of reads as a book. You could start like from the first blog and just go on and read it. And that led Joe to Wyckoff Analytics. And then Joe has taken different classes. I worked with Joe privately as well a little bit. And his presentation is going to be on the integration of the idea of the business cycle and Wyckoff structural analysis. There are quite a few innovative ideas, I would say, especially the relative rotation based on the Wyckoff structure. So kind of like, Wyckoff business cycle and relative rotation graphs from Julian de Compagnie combined. So a very interesting idea there. And again, before we go to the presentation, I want to say that this could be you. You could be this presenter or this type of the presenter. You could be our student who is producing this type of content. So with that, I'm really excited to pass it to Joe. and make him a presenter. Joe, how are you doing today?
Hi, Ramon. Doing good. Thank you for the intro.
Absolutely. All right, so we're switching to your screen.
Right.
Here we go. I can see your screen.
Okay. Just want to make sure. Is it showing the slide? You can see my mouse on it?
Yes, following the business cycle, and I can see your mouse. Yes.
Okay, perfect. All right. Well, hi, everyone. Today I'm going to present on following the business cycle. I'm Joe. I do have a Twitter, Aurelius PNF, if you'd like to connect with me there. And I also do a Substack where I do some weekly posts on the business cycle, if you'd like to check that out as well. So, sorry, having a little technical difficulty on my screen here. So exactly what is the business cycle? It's the normal, sequential, and repeated ups and downs of the economy. But what exactly does that mean? What are we talking about? And what we're saying is we're just looking at the economy to see, is it expanding or is it contracting? Are we growing or are we shrinking? And when it says normal, sequential, and repeated, normal is typical or expected. Sequential is that it will happen in a logical sequence. And repeated is that it happens over and over in the same way or similar way throughout history. So this diagram on the right here is from Stock Charts, which is based on the work that Martin Pring has done. And it is showing the ideal intermarket relationship between asset classes throughout the business cycle. So really, we're looking at the main asset classes of stocks, bonds, and commodities. And we want to understand, where is money flowing? Where is capital being put to work? And based on these money flows, we can understand where the strong hands are anticipating the economy to be going. And that's where we want to be. We want to understand what the strong hands are doing and then getting on board with them. So to walk through the business cycle diagram, the way I've thought about it, I've kind of broken it down into 4 simplified steps. Makes sense to me, and hopefully it'll help everyone else as well. So first, if we start on the left side, where stage 1 is where the economy is contracting or slowing. And we'd expect the data as news headlines to confirm this, and sentiment is definitely turning bearish. But at this time, we see bonds start to put in a bottom, while stocks and commodities are still in downtrends due to the slowing economy. So now, why do bonds start to improve ahead of stocks and commodities? And this is due to that expected fiscal and monetary stimulus that governments and central banks will pursue to start improving the economy. So as bonds start to improve, they are the inverse of rates, right? So bond prices go higher and we see rates go down. And as rates go down, more money becomes available in the system. And the idea of this more money available in the system, as an example, if we look at a business that is refinancing debt, and they can refinance that debt at a lower rate than before, then that increases the cash flow that they can invest or grow with. And for individuals, this is the same as being able to, buy a car with a lower loan payment, or refinance their home to a lower monthly mortgage, and they have more money to spend with. Okay, so now that there's more money available in the system, that money wants to go somewhere. It wants to make a return. And in anticipation of the economy turning around, stocks then start to improve as strong hands expect that consumer demand to grow and earnings to grow with it. This is what leads to more investment and growth. And this is stage 2, where sentiment has reached bearish extremes. The cover of The Economist is calling it the end of times, and everyone is still saying stocks must go lower. Yet somehow stocks find a bottom and start to improve as there is more investment and growth. So now as we move into stage 3, commodities begin to improve as there is more demand for raw goods due to all of the investment and growth in consumer demand. So as an example, consumers have been buying more Nike clothes. Nike has invested in new plant upgrades to make more shirts, and the end result is that Nike needs to buy more cotton, which drives the price of cotton higher. And that's just a simplified example. There might be 100 more companies between the consumer, Nike, and cotton, but this is essentially, what happens with other commodities as well. Until eventually, the economy starts to overheat. And by this, I mean there's more demand than there is supply. And we start to see all of those increased commodity prices get passed on more and more to the consumer. And this is what leads to inflation. All this demand for raw goods drives inflation higher. And this is where stage 4 comes in. The economy is now really growing, and all the data looks great. Sentiment is bullish, and we're all going to the moon. But the strong hands are anticipating what will come next, which is governments and central banks taking a tightening stance to fend off inflation. So all those low rates and high bond prices don't look as attractive anymore, and bonds begin to weaken, and this is where rates go up. So finally, into stage 5 and stage 6, as rates go up, this has the opposite effect of more money available in the system, and that there is now less money available in the system. So to revisit the example earlier, right, now that same business that could refinance at a lower rate and have more cash to do something with before, now they have to refinance at a higher rate, and they have less cash to do something with. And this same concept applies to the consumer and their spending as well. So now stocks turn lower first, and then commodities follow, all in anticipation of the economy slowing. And this is where growth slows until we start the cycle again with rates going down. So just to recap this business cycle on this slide, we can think of the cycle as more money available in the system, which leads to more investment and growth, which leads to more demand for raw goods, which ultimately leads to rates going up. Okay, so now that we have defined the business cycle and the stages, this diagram gives a little more detailed breakdown of the business cycle versus the stock market. So we can see the blue line is the business cycle, which we're going to call Main Street, and the orange line is the stock market, which we're going to call Wall Street. So like we've all heard before, it's Wall Street versus Main Street. And when we think about the timing of the stock market versus the economy, we can see that starting from the left, when the market is bottoming, is at the same time when the economy is in full recession. And by the time the economy is making a recovery, stocks are already in a strong bull market. And as stocks look to put in a market top, the economy is at its strongest and really flowing until it reaches full recovery and starts to turn over into a possible slowdown or recession. And when that happens, stocks are already in a strong bear market. So the main idea with this diagram is that the institutional strong hands are always months ahead of the economy and data. And this should make total sense to all of us as Wyckoffians, since we can do our bias analysis and read the tape to help determine what the strong hands might be doing ahead of time. So just for example, inflation has been the big headline lately, right? And recently in August, we had a lower CPI print, and the market rallied strong that day, up over 2%. But before that report was released, the market already moved up over 9% over the last month since the last CPI reading. So, take that for what you will, but in my mind, the strong hands were already accumulating in advance of that report. Okay, so now they're thinking about how Wyckoff and the business cycle work together. We can see that Wyckoff aligns really well with the business cycle. And when we look at the Wyckoff price cycle, it follows the same normal, sequential, and repeated steps as the business cycle. We have strong hands accumulating at the market bottom. They are primarily holding through the bull market, and then strong hands are distributing at the market top ahead of the economy, and then they are inactive or remaining short through the bear market. But the Wyckoff price cycle also reminds us that nothing moves directly in a straight line. Through the bull market, there's multiple reaccumulation trading ranges and markups before the market eventually reaches the top, and the same with redistributions and markdowns through the bear market. And this same type of concept can be applied to the business cycle. So just like in our Wyckoff analysis, and we determine what is the long-term, intermediate term, and short-term trends. Well, the economy is following the same logic with long-term cycles and short-term cycles. The economy is always ebbing and flowing throughout the business cycle. So that's where we have periods where it's growing faster, or it's growing slower, or it's even shrinking. And for example, when we look at real GDP growth from the end of the 2001 recession, beginning of the 2008 recession, over those 7 years, real GDP grew on average at 0.7% each quarter. But the highest quarterly growth was 1.67%, and the smallest quarterly growth was 0.13%. So I just rattled off a bunch of numbers there, but the idea is that the long-term cycle, the economy is expanding, but we have shorter-term cycles of faster expansion and slower expansion through that same time period. And when we think about markets, stocks are going to respond to these faster and slower expansions in the same way, which in my mind can be represented as these potential trading ranges. So how can we try to identify these trading ranges ahead of time? Because when we look at the main asset classes of just stocks, bonds, and commodities, it's not always as easy to recognize these shorter term cycles, as the main asset classes are primarily following the long-term cycle. So this is where evaluating sector rotation to understand which types of stocks are outperforming or underperforming the market can help us determine what stage we are in for the short-term cycle. And by identifying what stage of the short-term cycle we are in, we can potentially identify the potential change of characters throughout the long-term cycle and react accordingly. All right, so now that we're looking at sector rotation, and each specific sector is going to lead and lag based on the stage of the business cycle. So why exactly is that? And if we think back about the 4 steps of the business cycle, we can then better understand why a sector would outperform based on a certain stage. So starting with more money available in the system, technology and discretionary stocks will begin to outperform. These are the companies like Tesla, Nike, Starbucks, Apple, Microsoft, and Visa. These are consumer-facing businesses that will see immediate earnings improvement as soon as consumers spend more of that money that they have. As well, technology and discretionary companies that are smaller or early on can offer some of the greatest potential returns for investors as the economy begins to grow again. So now, as consumers are spending more of that money and businesses or investors are looking to make more investments to meet the growing demand, this is the more investment in growth step. Here's where communication services and industrials will start to outperform. This includes communication service stocks like Facebook, or Meta now, and Google, which benefit from increased advertising spend, but also companies like T-Mobile and Comcast, which provide the infrastructure for more data to flow. And with industrials, this includes UPS, which transports all of the goods, as well as Caterpillar and General Electric, which provides the actual machinery to produce the goods. So as the economy is growing, and now it's nearing full recovery, this is where all that economic growth leads to more demand for raw goods. And that is where materials and energy stocks start to outperform. These companies are in position to benefit the most from the rise in commodity prices, and in turn have increased earnings. So also at this time, as the market finds a top, investors start to become more defensive as they see the economy slowing ahead. So this is where consumer staples and healthcare stocks will outperform. Because as inflation goes up, consumers now are going to feel the squeeze and their discretionary spending has to decrease. But they still need to buy groceries and receive necessary medical care. Companies like Procter & Gamble, Coca-Cola, and Colgate, which produce everyday essentials, to Costco and Walmart, which sell the groceries that we all need to survive, will start to outperform. And the thing to note here with the sector rotation is we are talking about relative strength versus the broad market. So if stocks now are going down, consumer staples could still outperform just by going down by less. Ultimately, we reach the point where rates go up and utilities, financials, and real estate sectors begin to outperform. These sectors are defensive in nature, first, and that we all have to keep the lights on at our house with our utility company. And second, in that banks and real estate investment trusts might actually benefit from the rise in rates or rise in rents from inflation. So based on what sectors are outperforming when and what direction stocks overall are heading, this is how we can get a better sense of what stage of the business cycle we are in. All right, so we made it through all the background on the business cycle, the stages, strong hands, timing, how the sectors are rotating. So now let's get into the technicals and into the charting here. So first, I found the simplest way to look at charting the business cycle is just by doing a simple line chart with SPY, SPY for stocks, TLT for bonds, and DBC for commodities. And this is just a visual analysis, to see what direction each asset is going, and then correspond that to the business cycle stage. So this chart is showing from the February 2020 stock market top to around today, and just labeling what stage we are in from the visual analysis. And the biggest thing here is, it's lagging in the sense that not trying to call the exact turn, but more to confirm when we see a higher high with a higher low and then another higher high, or a lower high, lower low, lower high. We can see that there's a change of trend. And overall, this is very subjective. If we look back in 2020, where exactly stage 4, which is when bonds start to go down, where exactly it started, could be anywhere in here, right? Kind of up to whoever's doing the analysis and making sense of what makes sense to them. So it's not exact science, but it gives us the high level view of where we might be at in the business cycle. So now another tool I found to drill into a more detailed view of how each asset class is performing is on stock charts. The relative rotation graphs I found are really helpful. And just here I've put together an example of how I can do the Wyckoff comparative analysis using RRG. And I've included a screenshot of the RRG tool here on the left, and a screenshot of charts with the more traditional view of relative strength on the right. And we can see that Apple and Microsoft are in the leading quadrant, which on the chart shows that the relative strength line is moving up and above its moving average, which represents strength, whereas Visa, MasterCard, and Broadcom are all in the weakening and lagging quadrants, and their relative strength lines are moving down and below their moving average, which represents weakness. So overall, this aligns with our thinking of relative strength, comparative analysis, and that the tool can be useful. The other nice feature with the RRG is that it provides this tail length and gives us a great view of how the relative rotation has changed over time. So in this case, we're looking at like weekly bars, but you can adjust this to daily, or they even have intraday now. So it just depends on what you're looking for. And then the last thing I just add, I think like Roman had said, this tool was created from Julius de Campener, and he does have a weekly RRG video on Stock Charts YouTube. So if you'd like to learn more about it, I definitely start there and watch some of his videos. Okay, but now looking at the business cycle comparative analysis, we're looking at the business cycle RRG here, and we can enter the same SPY for stocks, TLT for bonds, DBC for commodities, and then we can see which quadrant they are currently in. And in this case, we want to see how they all compare versus cash. Is their value going up or is their value going down? And that's why we want to do the comparison versus cash. And as a tip, if you're looking to do this in stock charts, you can use this $1 as the symbol, and that'll just give you the comparison that it's just versus a flat cash position. Maybe if you were you're running a fund and you're trying to benchmark against something else, you can do that here as well. But if you're just looking at, is my account going up or down and where should I put money, you can use 1. So overall right here, we can see bonds are improving, stocks are improving, and commodities are weakening. Possible stage 2 behavior, possible market bottom. We'll keep moving. Don't want to call it yet. Okay, so now we're going to drill into the sector rotation and see what clues it might provide. And I've included 2 different graphs here that are already built into stock charts. You can select them from the drop down on the RRG tool. And it's the sector spider ETFs, which is the weighted ETFs, or the equal weight sector ETFs. And the main thing to think about when looking at weighted or equal weight is just to keep in mind how much of a particular stock makes up the ETF. So for example, we look at XLK, the technology ETF. Apple makes up about 24% of the ETF, whereas for RYT, which is the equal weight technology ETF, Apple makes up about 1.5%, which is about the same percentage as all the other stocks in the ETF. So the idea being is when we do our analysis and we look at the weighted ETF moving in a certain direction, is that due to 1 or 2 stocks that make up the majority of the ETF just going in that direction? Or are there more members of the sector all moving in that direction, which could be easier to pick up on the equal weight ETF? But ultimately, with our sector rotation RG, we just want to see what quadrants are the sectors are in, and if it points us towards we're in the early cycle, mid cycle, or late cycle. Okay, and the last thing I wanted to touch on with the RG is how we can apply and think about the Wyckoff phase analysis with the quadrants. And this has just been my view of how the rotation works and what I've seen from the short time I've been using it. So I think there's definitely more work and research can be done here and pull more examples. But essentially, the leading and lagging quadrants will usually be where we see stocks in their markups or markdowns, and they're entering into their climactic behaviors and beginning phase A or into phase B. Whereas the improving and weakening quadrants is where we can see the potential phase C and phase D type behavior. And this is mainly because the RRG tool is based on relative strength as well as relative momentum. So as we go vertically, this is either momentum improving or momentum decreasing. And as we move right to left horizontally, this is relative strength increasing or decreasing. So I think we can think about that with our phases, that we see momentum increase into phase C, phase D, and then what are we leading, are we lagging, based on what direction we come out of that. And then the other thing, just to point out with the RRG, is that in the ideal world, the rotation will work through all 4 quadrants, just a clockwise rotation each time. But in reality, the rotation might lead from leading to weakening, back to leading is a reaccumulation type structure, or from lagging to improving, back to lagging as a redistribution. And also just looking at the change in direction and the rotation can give us clues, as well as it can all take place inside of a quadrant. So it could come in here and do a full clockwise rotation right here as a type of redistribution. So those are things to think about and look at when you're using the RRG tool. Okay, so how do we actually put this all together where we can make a decision based on it? So let's do a case study. Okay, so we're going to look at this year, since we've had lots of action this year for sure. And we'll start in February. And the first thing we can do is we can look at our business cycle RRG, and we'll see that bonds are lagging, stocks are weakening, and commodities are leading. So our initial thought is, okay, bonds down, stocks down, commodities up. Okay, stage 5, that aligns with the economy is topping. So you can kind of think about that as, okay, what's happening with the data, the headlines, the Fed, these things, does it seem to correspond? And then we dive into our charts. So we can see with stocks, with the SPY, we've had, markup, uptrend into, looks like potentially, yeah, distribution top, change of behavior, sign of weakness, and now we're in a potential new trading range here. So does this make sense? Are we in a weakening with what we're seeing on the charts? And yeah, it makes sense here. So our bias is really after this, sign of weakness, change of behavior down, bias to the downside here, stocks down. Bonds, so we look at bonds, been in a large trading range, and now finally is breaking down, sign of weakness. We're seeing it in the lagging quadrant. So again, okay, bonds down, that makes sense. Commodities, and we see trading range, a breakout, some fierce backing up action, but right back up and up to the right, and we're seeing it leading, so commodities up. So this stage 5 behavior makes sense. So this is how we want to think about where do we want our positions, right? Not in bonds, not in stocks, but in commodities. And then we can look at the sector rotation and see, okay, does this also correspond? And just starting from kind of left going right, we can see technology, discretionary, industrials all in the lagging quadrant, whereas materials, energy, consumer staples, utilities, financials, all the mid to late cycle sectors, all in the leading. So again, early cycle lagging, mid to late cycle leading, lines up with stage 5. So February, we're expecting stocks down, bonds down, commodities up. Okay, now we're on to April 1st. So before we were somewhere around here, and now we're here. So we look at our RRG with the business cycle. We can see that stocks are now lagging, although they've made this nice turn, pick up in momentum. Looks like it wants to head to improving. Just something to note, but we're in the lagging quadrant. Bonds lagging and commodities leading, but we can see they've turned over and potentially losing momentum. So now we look into our charts and we can see since our last look, yep, we're in a trading range and we've had this impressive, potential change of behavior, breakout to the upside. So bias still, as we enter the trading range, bias is still to the downside, but we see the potential. Okay, there might be a potential that stocks are going to turn around here. So keep that in mind. But and then as we move to bonds, we can see, okay, since the last time we looked, we've just broken down even further. Maybe climactic, maybe not, still biased to the downside. Commodities, we can see since the last time they just had their huge climactic run, huge climactic volume, automatic reaction, secondary test, looks like, yep, we're in a trading range here. So we can definitely align with the idea that commodities might be peaked. Stocks still down, but might be improving, and bonds still down. So the idea here is we're probably stage 5, potentially stage 6. We'd expect that if we're going to go into stage 6, commodities will weaken further. And then we can look into our sector rotation, because at this time we're saying, well, we see this, are stocks really going to break out and go on to all-time highs or not? Is this just upthrust after distribution? And when we look at the sector rotation, we can see still technology, discretionary, industrials are all still lagging, while materials, energy, utilities are still leading. Note energy with commodities turning over. And we can see that there is some weakening, but for the most part, it still lends to the fact that the mid to late cycle is ahead of the early cycle. So I think idea with stocks here would still be, guilty until proven innocent. And we think that it's still to the downside. So now we look at July 8th. So if we were here April 1st, now on to July 8th, and our RRG shows that stocks are still lagging, but making a turn. bonds have now moved up into improving, and commodities have really dropped down out of leading and into weakening. And so when we look at our charts here, we can see, okay, since the last time, stocks have broken down, but we do see potential climactic behavior here, surge in volume, and potential trading range. So still want to say stocks to the downside, but there could be something happening. We see bonds, since our last time, they continue to move down. But again, we see some potential climactic behavior here. Looks like we might be trying to build a trading range, build a cause here. We do see some higher high, higher low, higher high, potentially higher low. So, and it lines up with the idea that bonds are improving. So at this time, I'm thinking, okay, we could be in stage one, right? Bonds are improving, stocks still down. And then if we go to commodities, we saw that from the last time we've been in this trading range, they had an upthrust after distribution and a big change of behavior, sign of weakness type move lower. And now, we'll see, does it break down or go into a trading range? But I think right here, this change of behavior says, okay, commodities are probably topped. And they're either going to go sideways or continue to break down. And we can really see that when we look at the RG going into the weakening. So at this time, we're thinking, okay, stage one, but what could be happening with stocks? And when we drill into the sector rotation, this is where we can see that now, since our last time, technology, discretionary, industrials are all in the improving, while communication services is lagging, but you can see the direction. It looks like it's right there heading into improving. Materials, energy, utilities, all weakening. Consumer staples in the leading, but right there on the line. Looks like by next week we're going to be in the weakening. And then real estate and financials in the lagging. But I think there also can be some other things in play there with how rates are going. So overall, we can say we really see the early cycle improving here. We see the mid to late cycle weakening here. And, I think in the words of Bruce, we see the green shoots. We see green shoots here. We see the potential that maybe stocks are going to improve. So where are we today? So I just pulled this from yesterday, and we just walk through the same steps here. We look at the business cycle RRG, we can see that bonds are improving, stocks are improving, and now commodities are lagging. When we look at our charts, we can see that since the last time we did see, now we have this change of behavior, bullish action, higher high, potential trading range, we'll see. But also we still have this kind of larger trading range, and could we just turn and go right back down? To be determined. But we can definitely see stocks are improving, looking a lot better. Bonds continue to build the cause. They're in a trading range. So not, at least we stopped and now we're moving sideways. So continue to make sense that we're improving there. And then commodities, since they're, that bearish change of behavior, have really gone sideways. And I mean, if this is a rally, it's not much of a rally, not much retracement there. So I'm still of the opinion that commodities are to the downside. Stocks, green shoots looking good, like a little more confirmation with the higher low here. And then same with bonds, but constructive behavior overall. And then when we look at the sector rotation, we can see that now technology is leading, industrials are leading, discretionary communication services are improving. The later cycles, consumer staples, utilities, healthcare, materials, energy, all weakening or lagging. So it seems like everything is there to say we could be in stage two. I think, well, we'll wait to see. I'm hesitant to make the call until we get that higher low onto a higher high to really say we're into a longer term bottom. But that's kind of where we're at today. So that's all I had today, Roman. If there's any questions or any thoughts?
Well, first of all, wow, what a fantastic presentation, Joe. Thank you so much. I was really looking forward to this, and I would love to solicit any of the questions from you guys. I mean, this is really, really, really great material. And it's in line of how, first of all, we teach Wyckoff methodology, look at the structure, compare the structures, to each other, from different sectors, industry groups, do your top-down approach in your selection, going from the sectors to the groups, from the market to the sectors to the groups to the stocks. And Bruce and I, we do this, every Wednesday in the WMD, class. With that, we're actually very lucky that we're joined by Bruce. Bruce and I, we kind of quickly discussed this presentation, and I said, well, listen, this is just too good to miss out on. So I invited Bruce to be a part of this. Joe, I know that this comes as a surprise a little bit, but let's just improvise a little bit here. Hey, Bruce, how you doing?
Oh, I'm terrific. Great presentation. I enjoyed it a lot.
Thank you.
Yeah, good job, Joe.
Well, Bruce, what kind of comments, questions do you have for Joe, or maybe some comments that we could go back to some slides? I mean, I'm just gonna kind of like cut in here a little bit and just say like that slide, and if we could go, Joe, back to the slide of the Wyckoff structural rotation. This one right here.
Oh.
No, the other one. Yeah, this one.
Yep.
I think this is a significant improvement, innovation, in understanding of how the structure unfolds. What leads to lagging or improving quadrants in the structure based on the relative strength analysis. Bruce, you and I, we've kind of been working on this as well. I told Joe, and he's very excited, to see where we're going to come to. What's your sense of this work, and like, what are your kind of thoughts, ideas here? How could we, as Wyckoffans, use this type of analysis?
Well, I believe that these are the major forces, as Joe explained so well. These are the major forces that drive financial markets, and we can see the interplay, the interaction between all these markets in the presentation today, and that there is a sequence, there is a logic to the way financial markets interact and work, and that the very large interests, if we go look at people like Druckenmiller, for instance, and many others, we can see that they basically are investing for these large moves. And we know that the composite operator is primarily interested in buying in the very early stages to benefit from these long trends that can last for years, and then also can go up multiples of their original investment, ideally. And so the best way to match up, I believe, for many of these investors, to be able to match up the potential of these big trends, is to tie them to the ebb and flow of business activity and how this takes place. And I think one of the great things that Joe has done today is he's really illustrated the idea that not only is there this rotation between asset classes, but also, very importantly, there's this rotation that occurs within the industry groups and the sectors, and that understanding that there are leading, coincident, and lagging sectors in the economy. And a really good example of that from Joe's work, and maybe Joe, we can talk a little bit about that from, if you see a slide that might apply to this, is like the notion of an early bull market cycle beneficiaries would be, and this is a question for Joe. So Joe, what are the classic sectors and industry groups that start to perform very early in a new uptrend, a new bull market, which are the ones that tend to dominate early.
Yeah, let me yeah, I'll kind of look at this one, right? So, you know, technology, discretionary, communication services, these
So,
type of, right?
yeah, beautiful. So for instance, you can see, look over here, and just so that I can orient everybody in where I'm thinking, is that you can see the orange line, which is the economy, and then you can see the stock market, and then you can see the blue line, which is the economy. Is that you can see that when you get down to the bottom of the stock market cycle there, stage 6, stage 1, look at the asset classes that are the first ones to act well. They're the last 3 over there on the right. They're all interest rate sensitive. And so the interest rate sensitive segments and sectors are the ones that start to show relative strength, and will show up in this tool that Joe so elegantly explained today, will show up early and lead in the late recession or the late bear market into the lows and into the early stages of a new bull market. And so that almost in and of itself is a clue to us that the markets are starting to get better. They're starting to improve. And so we want to see the banks do well. We want to see the insurance stocks. We want to see the utilities and home builders and so on, because they're all interest rate sensitive. And the reason that they can move before the economy has made its lows yet is because in the very late stages of an economic decline, actually the demand for money, and we know interest rates are the cost of money, is the demand for money starts to really sag. It starts to really fall off. And so investors and corporations don't have a demand for money because the economy is so weak. The factories are running at like 60 and 70% of capacity, and you have very high inventories, and they're trying to run off inventories. They have no need to borrow money. If anything, they're starting to shutter plant and equipment. And so the demand for money is low. That is what the first thing that happens that causes interest rates to fall. So the interest rate sensitives are the ones that are going to act well, even in the early stages of a bear market or the late stages of a bear market, and into the early stages of a new bull market. So all I'm saying here, and I went on too long, is just the idea that we can use sector and industry group analysis to help us to be able to identify where we are in the emergence of business cycle, leading, coincident, and lagging. And so the groups, and Joe really did a good job here, the groups that do well late in the cycle are the ones that benefit from higher commodity prices. And so you see energy start to heat up, and you see material stocks start to do well, and so on, because the whole economy is running at near full capacity. And so when you're running at full capacity, instead of running at 60% of capacity, you're running at 95%. Now you're in a position where you can raise prices, and you can raise prices faster than the cost of goods. And that really benefits the industrial stocks, the energy stocks, and so on. So anyway, I'll be quiet now. But this is a really big part of this work. And I'm really curious to see more from Joe on how the RRG type tools can be used to help us to peg where we are in the unfolding cycle. Because keep in mind that like from the low point of the business cycle to the next low point in the business cycle, so a whole cycle can be 4, 5, 6 years long. So lots is going to happen. A lot of rotation is going to happen as the cycle unfolds. and we want to be on the leading edge of that. So that's all I'll say for now. But Joe, your thoughts, comments, questions, anything?
No, yeah, that was great. I don't really have anything to add there. I think the way you said it is the way I've been trying to think about it, and I think just like you said, whether looking at the relative strength on the charts or looking at it with the RRG tool, I think it just helps to kind of put in the mindset of why are certain sectors doing what they're doing, and does that kind of align with the bigger picture? And then when it starts to make sense, it becomes a little easier to make that decision, go a certain way or not.
Exactly. And so this is why your work is so innovative here. So I think it's quite good. And I believe that you're going to, with your work and your studies, I think you're going to add a lot more to this body of work, and you've already added a lot. So there's so much in this world of thinking. And the beauty of it is, Joe, is that you are in an area where the really big composite operators and institutions, this is the work that they're interested in. This is where they need to be, because when they find an investment that they really like, they want to hold on to that investment for the duration of the uptrend, if at all humanly possible.
Yeah,
Well,
definitely makes sense.
all right. Well, Bruce, thank you so much. And I'm just looking at the comments, Joe, just a lot of comments, kind of like praise and comments. Great presentation. Excellent. Thank you. Wow. Excellent. Great job. This is good stuff. Great presentation. Nice to see RGG and Wyckoff combo and so on and so forth. The question that kind of is a repeated question here is, would the slides be available? Joe, we haven't discussed that.
Yeah, but I can, happy to share them, and everyone can look through them,
Okay.
give feedback, definitely.
Okay. Okay, another question here. It seems like RRG moves faster than the business cycle, from Chris. What do you think, Joe?
Well, I think potentially, based on, I think that's where looking at the tail length really helps, because like you can see here, let's just say like discretionary is improving and up and moving up to the right, whereas like communication services is improving. They're both in the improving, but you can see here definitely less momentum. So I think it gives a little bit to what could be coming, and not necessarily just looking at it like, okay, yep, they're both in improving and they're both going higher. It could give a little bit of that leading indicator, like you're thinking.
Mm-hmm. Okay,
I can add a
Joe.
little bit to that, just from a different perspective, not from the RRG, but this is something that for Joe to consider as he's working with these RRG tools, is that I like to use relative strength, classic relative strength charts. And the key to identifying a trend is to be able to segment the time frame correctly for the trend that you're trying to capture. So for instance, let's say that a business cycle is 4 years in duration, low to low or high to high, either way, is that you, to be able to see an emerging trend, with some sensitivity, is that you want to break up the uptrend into a fraction of the size of the trend. So let's say that if the whole trend low to low is 4 years in duration, this is just a classic example, but that means that the bull market for that asset class or that stock might be 2.5, 3 years long, and in a classic business cycle. So what you want to do typically is to break up that uptrend into about a third of that time frame. And so what I do is, so a third of that time frame would be 12 months. And I actually use 39 weeks, and I'd look at weekly charts for this work. But if you break up the uptrend into thirds, and then make your tools about a third of that time frame. And so what I do is I use a 39-week moving average of relative strength, and I use weekly charts for price. You're going to pick up the trends that are going to align with a 2 to 3 year uptrend or a 1 to 2 year downtrend. Does that make sense? And so just think about how to match up. And I don't know how you do this with RRG, but Joel know. Joel figured this out, or he already knows. And that is that you want to set up the time frame that you're matching against by about a quarter to a third of the trend that you're trying to identify and capture.
Yeah, and I think the only thing I just add when talking about the RRG is that's actually why I look at the weekly as well.
There you go.
I think
you're already doing this.
On the daily, it's it's going to pick up a lot faster, and and all those different smaller moves and maybe smaller swings is going to happen on the daily. It could do a full rotation, by the time that NVIDIA here is started to move to the right, move sideways, losing momentum. Well, on the daily, that could have already done a full rotation. So
exactly, yes.
Bruce saying what's the time frame, and make sure it's aligned with what you're thinking, and ultimately how long it's going to take or how long it's going to play out.
Perfect.
All right. Well, I don't necessarily see any other questions from our students here. And unfortunately, I do not see our second speaker, Arif, who is in the Middle East, I believe. And with that, I think that we're probably going to have just one presentation by Joe for this event. If there are any late questions, guys, please write them down right now. Otherwise, we're going to stop here pretty soon. Joe, here's another question. I mean, I really love how you put everything together. You look at the market. You go from the this top-down approach where you look at the market, then you look at the sectors. You're visualizing that rotation through the relative rotation graph. Then you have a really good understanding of like, okay, what's going on with the sectors? What are they showing me in terms of the business cycle, the stage that we are in? And I think that the next great point is just like to go to the industry group levels and say in the current business cycle stage, what are the most interesting candidates that I should look at that are showing me the correct Wyckoff structure, that are showing me the correct Wyckoff bias, that are showing me the correct Wyckoff character, and then what happens then? I want to know the moment of where the tire meets the road, right? So you've done all of this. What are the trades that could originate from there? How long are you going to stay with those trades? What are the parameters of those trades? So could you talk a little bit about, tactical optics for us?
Yeah. So I mean, right now, like you said, top down, get the sense of what direction each kind of asset class is heading, and then look at the sectors and see, does that match up with what we're thinking? So, as we look back at July here, we saw the potential green shoots, we saw technology, discretionary, industrials were all improving. So, at that time, went and looked at technology and discretionary stocks, run different scans, look through different charts, and then try to put on positions specifically in those stocks and avoid other sectors that are in the weakening or lagging. And so one thing I've still, and I think like you said, that's probably a great next step, is to go from the sector to then an RRG of the industries, and then of an industry that's an improving, moving towards leading, do an RRG of the stocks in that industry, and then go from there. But kind of aligning with the idea that, you know, improving. So let's say it's an accumulation. So it's been in lagging, and now it's moving into improving. And then if we look at the chart and we say, okay, yeah, I see that, you know, let's say here for commodities, like, okay, I see it's been in a trading range. It's had this move up, looks like an upthrust after distribution, and we're now seeing this breakdown, and it's going down into the weakening. You know, this kind of aligns with the idea that, okay, this could be a phase C sign of weakness right here. And the timing makes sense, the phases make sense, like this all kind of lines up with the idea that commodities could be going lower. And then think of it, okay, so energy or material stocks, and drill down into those. So the way I kind of thought about with specifically trying to generate ideas, you know, what's in improving, what's in weakening, what's the charts look like? Does it look like it's in a phase C accumulation or phase C or phase D distribution? What's happening? And then just try to drill further down in those sectors to the specific stocks. But I think, like you said, the next step really is to say, go from the sector to then industry RRG and then stock RRG.
Okay. Also, Joe, could you show us your blog? Because Joe is publishing a blog, so I would suggest you guys sign up for that. There are a lot of Wyckoff ideas. We are trying also to have Joe's blog being displayed on our website. That is coming. But for now, if you could check out his blog, which is called, I believe, the Marcus Report. And by the way, I'm a very big fan of Stoicism, and actually I read each day a small piece on Stoicism. It kind of appeals to me a lot. What's your interest in this? I mean, like, what is so appealing to you in Stoicism that you're using this reference so much?
Yeah, so so I call it the Marcus Report. You know, I write under the name Marcus Aurelius just for fun. I think, like you're saying with Stoicism, it makes a lot of sense to me, and I think it also just helps with being able to deal with markets, right? You know, there's kind of this idea, quote, Marcus Aurelius said, you know, you have power over your mind, not outside events. You know, we can't control the market. We don't know what it's going to do, but we try to look at all the leaves and come up with a decision. And then being able just kind of to endure through, you know, the pains of it, as well as understand the, you know, cherish the good times, but endure the pains. Just make sure that you're sticking to what you think is right, what your ideas are, and that you know, you can only control what you can control. You can't control that, you know, some invasion happens or something else happens. You just got to deal with what has happened and make your best decision going forward from there. So that's kind of why I've found Stoicism to help me a lot through my trading, and also just not just trading, but in life as well. Yeah, totally agree on Stoicism.
Yeah, I find it also extremely helpful to have that mindset, because this Stoicism to me basically is all about one idea. You're not gonna know what's gonna happen in life, and then, you know, you could apply this to the market. You will never know what's coming, when it's coming, but you can surely know that something will happen in your life or in the marketplace, and then you kind of go through this, and it just helps to grow, I think, as a trader. You know, and even if you have some kind of temporary defeat, you fall down, you get up, because there is an underlying stoic idea of, if you keep getting up, you will keep improving, and that's very appealing. Okay, well, Joe, could you show us a little bit your blog? How is it structured? What is the main thrust of the ideas that you put on the weekly basis?
Yeah, so it's aureliuspnf.substack.com, and so every week do a post on kind of that top-down business cycle look. So recap kind of the executive summary of everything, but looking at the business cycle, kind of looking at that high-level line chart and aligning, okay, what stage do we think we're in? And then going into the RG of asset rotation. So on here, I include some more ETFs. So like for bonds, we have high yield as well as the TLT long bond. And then for stocks, Dow Jones, biotech, small caps, transports, NASDAQ, semis, S&P. So just kind of a lot of different looks at the market. And then for commodities, instead of just doing like DBC, DBA for agriculture, GLD for gold, and USO for oil. So just kind of a little broke down a little more from just the high level stocks, bonds, commodities, just to get a sense of what things are moving. And then into the sector rotation and just looking at what's improving, leading, lagging, weakening, how does that align? And then ultimately looking at the charts. And I'll just put up kind of the daily view as well as like an intraday view. I don't get too technical on these charts as far as all the labeling and everything, but just kind of to use it as a background with idea of what's going on and what structures we're looking at. And then into what type of things could be happening internally in the market. So I usually like to watch stock breadth. So always looking at like the NYSE advancers and decliners, as well as like short-term breadth indicators. And then the other thing is like right now looking a lot at like growth versus value. So I'll usually put up some other charts that kind of either help with the idea of what's going on with the market or that something is changing. But this is kind of the idea to get from what business cycle we're in and what asset classes, the direction they're heading. And then the other post I started doing was just this called the past week with PNF charting. And on here, just walk through kind of the main stock ETFs and looking at the PNF charts and just seeing what I see, what I think is going on, as well as, like the last couple of weeks had PNF targets on here. But now, in S&P, at least on the count I had, that we hit the target and now potentially into a trading range. But so I'll cover the stocks, cover bonds, commodities, and then just do like a weekly highlight. So yesterday, big news out of China with some stimulus, and a lot of Chinese stocks were perking up. So just covering the China ETF and then specifically Alibaba, and looking at that as well as any supporting material. So just try to look at the same idea, look at stocks, bonds, and commodities PNF charts, and then kind of what's a weekly idea, what's going on, and could be a potential opportunity.
Excellent. Hamid is asking, what is your Twitter handle? I believe at Marcus Aurelius.
It's just this Aurelius PNF.
Aurelius PNF. That's the one. Okay.
Yep.
Yes, please subscribe to Joe's blog. Again, we are trying to get Joe's material on our website as well. So for those of you who are, users of our website, you'll definitely find that material there. A couple of other questions from students. Chris is asking, can you follow inflation with this system, and does that lead or lag?
Yeah, so I think the main idea with inflation is like the idea of, we talked about like the four main steps. So more money available leads to more investment, leads to more demand for raw goods. So that more demand for raw goods is the all the commodities, all the raw goods that go into products, which is going to eventually pass on to the consumer, which will lead to inflation. So thinking about that, like right here, we're going to see materials and energy stocks are really starting to outperform, and we can kind of look at, okay, what's happening with commodity prices, what's happening with materials and energy stocks. We see, commodity prices are going higher, and then, we can watch the data that gets released. But I mean, I think if we just look at this past year, we see like CPI prints were starting to go higher, listening to what the Fed is saying. Do we think inflation's coming? Well, if we looked at commodity prices and we looked at material and energy stocks, everything was pointing that inflation was going higher. And then by time kind of all the news is coming that all these big rates are going to happen and inflation's a real problem. I mean, at that time the markets kind of was already at topping and moving lower, while commodities were still moving higher until eventually where we are right now, potentially breaking down or at least moving sideways or in a trading range. So yeah, I think that this kind of helps with that idea of trying to see what's happening with inflation.
All right, sounds
If
good.
I can just add one thing to that, the CPI and PPI data are going to be greatly lagging. They'll be way behind. So for instance, the classic sectors that Joe's talking about, materials, energy, late cycle beneficiaries, which we're looking at actually the trading of the stocks, and stocks tend to be leading to their the business cycle, or leading to inflation cycles, et cetera. So just keep in mind that by the time CPI peaks out and turns down, the stock market has figured this out 6 months to a year prior to that. So the CPI, PPI data will be very lagging to the internal components that drive CPI and PPI up and down.
Okay.
Yeah.
Thank you, Bruce. Joe, another question. This comes from Safan. Are you using the concept for the swing trading? Can we use it for smaller time frames, such as daily, or even smaller, like 15 minutes?
Yeah, so that's one thing with the RRG is on stock charts, this actually just came out I think a couple weeks ago, but you can now drill down into intraday. So I think they always had monthly and weekly and daily kind of bars, and now you can drill down in intraday. I haven't done that much on intraday, and looking at it, I think even with the daily, I'd say where I'm kind of at is looking at it. I look at the weekly, and I'm trying to get a sense of what's probably going to happen over this next quarter, and then looking at ideas in that kind of time frame and mindset, so like a swing type of trade. But I think you could apply the same type of concept, drilling down more into the daily, or even here saying, okay, discretionary stocks are improving, they're moving towards leading, I want to look at discretionary. Now I'm going to go down into the daily, and I'm going to wait until I see it in a weakening and turn back up, and then that's when I'm going to get into discretionary stocks, something like that. Yeah, it could be a way to drill down and find great opportunities.
Okay. All right. Well, I think that we are running out of questions here. Joe, this was a fantastic presentation. We definitely talk a lot about the business cycle, especially Bruce during the WMD. We talk about a lot about the like a structural analysis in WTC courses and so on and so forth. So it's just so nicely put together, all of it. So it was just a joy to listen to your presentation and to listen to Bruce interactions with you. So thank you so much. We appreciate this.
Yeah, no, thank you, Roman. Thank you, Bruce. And yeah, thanks everyone. Yeah, this was fun.
All right. And
good job, Joe.
Yeah, we definitely thank Bruce as well. Bruce was interested in watching this presentation, and then just like great improvisation here on our part, just to bring Bruce into this discussion. All right. Well, with this, guys, I want to say that we are probably close to being done here. Unfortunately, I do not see Arif coming to us for his presentation, and I'm just going to go through some of the other announcements. Specifically, I would love to invite you all to the Wyckoff Market discussion. This class is a Wednesday class together I conducted with Bruce Fraser, who you just listened to. And we usually discuss the current market conditions. And top-down approach is the one that we use so often, if not each session. And the key for us is to address two key questions. What is the market doing? And then what kind of stock selection or any other asset selection could we possibly go through? We do have different segments there. For instance, anatomy of the trade, where we are trading a stock or two together with students throughout the weeks that are unfolding. We also have the scanning segment where John presents his Wyckoff market report. So please go check this out. This is a weekly edition of the Wyckoff structural analysis using scanning. And John is bringing the innovation here of Wyckoff contextual scanning. So scanning for the places of Wyckoff events like spring, last point of support, breakouts, breakdowns, sign of strength, sign of weakness, and so many other ideas. So those are usually very interesting segments. I also would like to point everyone's attention to a very popular bias game that we play on Twitter and also on our website. It's completely free to all of you. And the challenge of the bias game is that we give you, at the beginning of the week, usually on Wednesdays, a chart to analyze and decipher for the bias. Is this an accumulation or is this a distribution? You could vote on our Twitter. We usually have a poll. So you could see how other people are voting on that particular chart. And then on Friday, the solution chart comes out on Twitter. And you could see our labeling, you could read our Wyckoff story, and that's an educational tool. This is something that our students are very fond of, that they follow religiously, on a weekly basis. And I would advise you to do the same if you just want, to keep applying Wyckoffian skills, to your analysis. Also, you could go to our website, wyckoffanalytics.com. We have all of the bias games, around 150 of those right now on our website, and one by one go through them, and solve all of those puzzles. Also, I want to mention that Wyckoff Analytics publishes a weekly newsletter. It is free. You could sign up on our website, and usually we inform you about our market update opinions. Those are usually either video segments or some kind of tweets on the analysis. We show you what is the latest content that comes out of Wyckoff Analytics and what upcoming events we expect. So if any interest, please sign up to that. Our YouTube channel is also completely free, and you could find over 150 educational videos on Wyckoff methodology. Wyckoff Trading Method is the name of our YouTube channel, so check it out. And our Twitter handle is @Wyckoff Analysis. So check that out as well. We publish a lot of analysis and research on the market, as well as announcements about upcoming classes. All right. Well, with this, I'm really grateful to Joe for his presentation, for his stoic approach to how he views the market. I also would like to thank very much our own Bruce Fraser, who stepped in and improvised here with Joe. Bruce spends a lot of time going through this material, on business cycle. He was actually a partner to Joe Turner and Martin Preen. And as we know, Joe's work is based on Martin Preen's business cycle. All right. Well, with this, if there is nothing else, thank you so much for being here. Thank you for being a part of our community. And we're looking forward to seeing you in classes. Don't forget about our free sessions on Monday and Tuesday. Thank you, everyone, so much. And until the next session. Bye-bye.